So let's start the review on adjusting entries. So the first thing about adjusting entries, there's two different types. So we're going to have deferrals and accruals. So those are the two different types of adjusting entries. And then within each type, we have multiple different types of deferrals and multiple different types of accruals. So let's start with just deferrals here. These are your prepaid expenses. So that's when we pay for prepaid insurance, or we pay for prepaid rent, supplies, right? All of these things, we pay for them up front, and then we expense them. We record the expense when they're used. Another is unearned revenues. So that's whenever we receive cash before we do the work, right? So we've talked about in other reviews, these are things like gift cards and plane tickets, right? These are unearned revenues. So we can remember that these are deferrals because we are deferring the expense and the revenue to a later date, right? For prepaid expenses, we purchased that prepaid rent on July 1st, let's say. We are deferring the recording of the expense until a later date. For unearned revenues, we collect the money up front and we are deferring the recording of the revenues until a later date. So those are your two different types of deferrals. And then under accruals, we have accrued revenues. So that's if we've performed the services, but we hadn't recorded that yet. And then we have accrued expenses. That's if the expenses incurred or the expenses happened, but we haven't recorded those expenses yet. So those are our types of adjusting entries. Now, when we prepare these adjusting entries, there's a few different rules that we're going to want to follow. First, every single adjusting entry is going to have either a debit to an expense or a credit to a revenue. And that is guaranteed, right? So every single adjusting entry needs to have either an expense or a revenue. Your other account is going to be a balance sheet account, right? We need one balance sheet account and one income statement account. So the income statement account is taken care of with our first rule there, the debit to an expense or credit to a revenue. The balance sheet account, that's your assets, liabilities, and owner's capital, right? So that's going to be the other account in your adjusting entry. Then the third one, we never involve cash in our adjusting entries. So a few different reasons here. First, these adjusting entries are not for transactions per se, right? These are to adjust balances. These are to update balances in accounts. We aren't going to be using $1,000 of supplies at the end of every month. But throughout the month, we had used those supplies, and so we need to make this adjusting entry. We need to update our balances. So there's never going to be a time where you received cash or that you spent cash without recording it, right? If we came back to the office with $1,000 in cash, we're going to have to explain where we got that cash from right then and there. We can't put that off a few weeks. Same sort of deal if we come back to the office and we spent $1,000 in cash. We have to explain where that cash went, right? So that's why these adjusting entries are never going to include cash. So we'll remember these three rules when we start preparing our adjusting entries in this review. So we're given a trial balance for Artie LLC, right? We have a long list of accounts and their balances. And then we have some information over on the right. We're told that the trial balance shows the account balances for Artie LLC on July 31st, and we need to prepare the following adjusting entries for the month of July. So we have 6 different adjusting entries that we have to prepare for this month. We need to prepare an adjusting entry dealing with supplies, right? Because we're told there's $1,000 of supplies on hand. Then we're told that prepaid insurance is a 1-year policy that began on July 1st of 2020. We're told that the equipment depreciated $200. 1/5 of the unearned service revenue is earned. $5,000 of services have been performed but have not yet been recorded. And then we received a $500 utility bill due on August 10th, or due next month. Right, so those are the 6 different adjusting entries that we need to prepare here in this problem. So let's work on the first one. It says there's $1,000 of supplies on hand. So this is when we take a look at our trial balance, and we take a look at supplies, our third account down. And we see that going into work today, we thought that we had $3,000 worth of supplies. Well, when we checked, we only had $1,000. Right? We're told that there's only $1,000 of supplies on hand. So we used $2,000 worth of supplies, right? 3,000 minus 1,000 shows that we used $2,000 worth. That's what this entry has to be for. It has to show that we have used $2,000 of supplies. So how are we going to do this? Well, we need to debit supplies expense because we have used up our supplies, so now we expense it, right? So we are debiting an expense here. And if we think back to our 3 different rules, we know that the other account has to be a balance sheet account. That's going to be supplies. And so we will credit our supplies in this entry to decrease our balance in supplies, because we have used up $1,000 of supplies, or we've used up $2,000 worth of supplies. So we need to show that our supplies balance is decreasing. Now, how much is it decreasing by? That $2,000, right? We initially had a balance of $3,000 in that account. We check here at the end of the month, we only have $1,000 left. So we've used up $2,000 worth. I want you to notice here early on, we have supplies expense and supplies. Notice that there's a similar word in both of those accounts, because that's going to be a pattern that we're going to see throughout our adjusting entries. Now, prepaid insurance is a 1-year policy that began on July 1st, 2020. So at the beginning of the month, we purchased a 1-year insurance policy, and we can see over on our trial balance that that 1-year insurance policy was $2,400. Right? Over on our trial balance, our 4th account down is our prepaid insurance. So what we need to do here is we need to show that we've used up 1 month of this insurance policy. So we've used it up. So that means that it's going to be an expense. And what type of expense? Insurance expense, right? Because what are we using up? We're using up insurance. So we will debit our insurance expense, and then we want to credit our prepaid insurance because we need to show that our prepaid insurance doesn't have a full year in that account balance anymore, right? By the end of July, we only have 11 months left of this insurance policy that we purchased. Now, how do we figure out the number here? Well, we take a look at the balance in prepaid insurance, and we see that it's $2,400. And we know that that's a 1-year policy. And here we're recording an adjusting entry for just 1 month. So what we do is we take 2,400 divided by 12 for 12 months in a year, and we see that each month we're going to expense or chip away at the balance of prepaid insurance by $200. So we will debit our insurance expense $200 and credit our prepaid insurance $200. So our expenses are going up here, and our asset account of prepaid insurance is decreasing because we've used up more insurance. Now, we're told that our equipment depreciated $200 this month. So, any kind of equipment or buildings, those are going to depreciate over time, right? They're going to lose value. But when we record this, we don't want to deal with the equipment account itself, right? That equipment account is only going to be used whenever we buy or sell equipment. When we record our depreciation, we have a few other accounts that we're going to use. First, it's going to be our depreciation expense, because we need to show that that we are depreciating our equipment here. Right? So we're going to have more expenses. Then we credit an account called accumulated depreciation equipment. And you'll notice that account right below equipment on our trial balance. And you'll see that that account has a credit balance on the trial balance. Accumulated depreciation is a contra asset. It goes against your assets. So it also acts in a way opposite of assets. So accumulated depreciation has a normal credit balance, meaning it will go up with a credit. So here, we are increasing our expense by debiting depreciation expense. We're also increasing accumulated depreciation by crediting that contra asset account. Now, how do we figure out our number here? Well, we're told that the equipment depreciated $200. So we'll just toss the 200 into this journal entry. And realize we are not messing with the equipment account itself. Accumulated depreciation will show up on a balance sheet right below the asset that it's depreciating, and that's how we will show the new book value, or what that equipment's worth after the depreciation. But the $50,000 for equipment does not get affected here when it's depreciating. Now we're told that in July, 1/5 of the unearned service revenue is earned. So we take a look over at our trial balance. We see that unearned service revenue has $10,000 as its balance. So think of this company. You signed a 5-month contract with a customer, and here you have now earned 1 month of that revenue. So what we need to do is we will need to debit our unearned service revenue, because if we've now earned some of this, that means that we're going to have less unearned service revenue. And remember, that's a liability account. So we're decreasing our unearned service revenue in this entry. And whenever we earn revenue, we credit service revenue. Right? So we're still following that first rule where we either debit an expense or credit a revenue. Right? Here, we're crediting that revenue. Now, how to figure out the number in this case? Well, we're told that 1/5 of our unearned service revenue is earned, and our unearned service revenue had a balance of $10,000. So we take that $10,000, you can multiply it by 1/5, or you can just divide it by 5. In either case, you will see that that will be $2,000. So you've earned $2,000 of your previously unearned service revenue. So we're decreasing the liability here, and we're increasing our revenues because we've now done this work. Now, $5,000 of services have been performed but have not been recorded. So, in this case, this goes back to what we were talking about with cash. If you would have performed these services and brought back $5,000 to the office, someone's going to ask you where you got that $5,000. Here, these services were performed. You haven't recorded them yet. So why not? Well, you haven't gotten paid yet, right? So it just hasn't been recorded. So if you performed services but haven't been paid yet, that entry is going to include a debit to accounts receivable, right? Because we need to show that our customers owe us $5,000 more. And then we want to record the revenue itself because we've done this work, right? We've performed these services, so we need to show that we've earned our revenues. And how much? It's just the $5,000, because we were told that there were $5,000 of services that we performed that we needed to record here at the end of the month. Now, we received a $500 utility bill due August 10th. So what we need to do is we need to make sure that we are counting that utility expense in the month that it happened. Right? It doesn't matter that we aren't going to pay that utility bill until next month. We need to count the utility expense this month. And how do we do that? We debit our utilities expense in this adjusting entry, right? We are debiting our expense to record that there were $500 of utilities in July. Now, we aren't paying it now, right? If we paid it now, that would be cash, and then that wouldn't be an adjusting entry. So if it's due down the road on August 10th, how do we record that? Accounts payable. Right? Accounts payable is our liability account whenever we owe someone money. So here we owe the utility company $500 on August 10th. So we need to credit our accounts payable. Now, how much? $500. Because all that's happening here is we are counting the expense and we show that we owe $500 more. So there's all of those adjusting entries that we work through. And I want you to notice the first 4 entries there. Supplies expense, supplies. Insurance expense, prepaid insurance. Depreciation expense, accumulated depreciation, equipment. Unearned service revenue, service revenue. They have words in common, right? So if you're stuck on one of these, think, is there another account that shares a common word, right? If you knew for certain in that first entry, I know I need to credit supplies, then I want you to take a step back and think, okay, what's my debit going to be? Well, I know that if I am not crediting in a revenue, then I know that I must be debiting an expense. So we know that our debit has to be an expense. And you might sit there and think, okay, I don't know what expense I'm supposed to pick. Supplies expense, right? So a common hurdle that I see students trying to get over is sometimes overthinking adjusting entries can get you in trouble, right? They can be difficult, but I don't want you to get too stuck on the account titles, right? Because a lot of times the account titles match up in a way. So whenever you are dealing with an adjusting entry for supplies, you will always debit supplies expense and credit supplies. Whenever you're dealing with depreciation, we're always going to be debiting depreciation expense and crediting accumulated depreciation. So you'll get into a pattern where it'll just flow once you practice this enough, and you'll start realizing the similarities between all of these accounts in these entries. So we have all of these adjusting entries, right? And then we have our trial balance over on the left. Well, after you prepare all of your adjusting entries, your trial balance isn't true anymore, right? For example, supplies, we knew that we only had $1,000 left in supplies. Well, if we look on our trial balance, it says that we have 3,000. So what we need to do is we need to make an adjusted trial balance. So all this is a trial balance with the new updated balance numbers. It's set up the same sort of way. We just need to update these amounts. So we'll go step by step here. So we'll take a look at our first entry. So supplies expense and supplies. So we have to increase our supplies expense by 2,000. So if you'll notice, it was 8,400 and now it's 10,400 because we're increasing it by 2,000. And then our supplies, those were 3,000, and then we decrease them to just 1,000 because we only had $1,000 of supplies on hand. Now, our next entry, insurance expense and prepaid insurance. Well, prepaid insurance, that's just going to decrease your prepaid insurance balance down to by 200, right? It's going to go down to 2,200. But you'll notice insurance expense isn't located anywhere on this adjusted trial balance. So that means that you didn't have that account previously. There was no balance in your insurance expense account. So what we need to do is we just add it on the bottom. So we put our insurance expense of $200. And then you can also see the prepaid insurance balance changed as well. So now our third adjusting entry dealt with depreciation, right? Depreciation expense and accumulated depreciation equipment. Well, depreciation expense, just like insurance expense, wasn't located on here. So we'll have to add depreciation expense to our adjusted trial balance as well. And then our accumulated depreciation, we credited that account 200. So that's going to increase your accumulated depreciation up to 5,200. Now, our unearned service revenue that we earned, right? We earned 1/5 of our previously unearned service revenue. So we debited the liability account. We debited unearned service revenue for 2,000. And then we credited service revenue for 2,000. So we need to update both of those account balances. So our unearned service revenue is going to decrease by 2,000, and our service revenue is going to increase by 2,000. So we'll see those changes made to our adjusted trial balance. Now our fifth adjusting entry, we see our accounts receivable and our service revenue changing. So accounts receivable had to increase by 5,000 and service revenue had to increase by 5,000. So we make those changes on our adjusted trial balance. And then our final adjusting entry, we debited utilities expense and we credited accounts payable. So we need to see that our utilities expense increased by 500 and our accounts payable increased by 500. So we're left with these balances after that entry. So you would post these adjusting entries into a ledger or into your T accounts, and then you would prepare a new adjusted trial balance with all of your up-to-date balance amounts. And then once you do that, the rest of the trial balance setup is exactly the same, right? We list out all of our accounts, list out their balances in either the debit column or the credit column. Then we have to total up our debits and total up our credits, right? So if you total up all of your debits, you should get 121,700. And then if you total up all of your credits, 121,700, right? And those two amounts equal. And that's not a coincidence. Your debits must equal your credits, right? Just like in journal entries, same thing is true on a trial balance. So we make these adjusting entries to update account balances. That's the main purpose of these, right? Is to go into the end of the month or the end of an accounting period with updated account balances. Because after we do this, we're going to prepare financial statements, right? And we want to be able to use as up-to-date numbers as we possibly can when we prepare those statements.